Good evening, everyone. Thank you for joining us today. Session number one on navigating your corporate financial and retirement benefits webinar. I'm Glenn Smith, and I'm pleased to welcome you. Today, you'll hear from Tim Allen and Andrew Schmall, certified financial planners at GDS Wealth Management, and they're going to cover two critical topics: salaried savings plans, maximizing savings, mega backdoor Roth strategies, distribution methods for retirement and in-service withdrawals. And secondly, they're going to be covering pension plans, monthly payout options, lump sum calculations, and factors like health conditioning and timing. If you have any questions, please write them down in the Q&A, and they'll be able to answer them at the end of the session. We hope this session provides valuable insights and practical strategies for your financial and retirement benefits. If you have any questions or want to learn how to reach us and for further follow-up, we're happy to answer any additional questions as well. Don't forget to join us Wednesday for the next 2 weeks on employee stock option plans and self-directed brokerage accounts. Without further ado, let's get it started. Please help me welcome Tim Allen and Andrew Schmall.
Thank you, Glenn. For the first part of tonight's webinar, I'll be going over features and benefits of employer-sponsored retirement plans. After that, I'll pass the mic off to Andrew to go over pension plans. Now, when we use the term employer-sponsored plan, that's an umbrella term that includes a variety of different types of plans. For today's discussion, we'll be focused on 401k plans specifically, which for Lockheed Martin employees is referred to as a salaried savings plan. Employers typically offer 401ks to facilitate and encourage employees to save for retirement, but also as a benefit that's helpful in employee acquisition and retention. This is an area that I'll say Lockheed Martin has been able to hang their hat on over the years as far as incentives and benefits available to their employees. So many of which we'll touch on tonight and throughout the series. So what's in it for you as an employee? People invest in their 401ks for a number of reasons. One of the most common ones is because their company offers a match on all or a part of their contributions, which means free money. For some people, though, it's about reducing taxable income. As an example, if someone earning a $100,000 annual salary contributes 10% to their paycheck to a 401k, their taxable income for the year is reduced to $90,000. Another benefit of contributing to a 401k is the tax-deferred growth, meaning you don't pay a penny in taxes until you actually withdraw funds from your 401k. Lastly, for those with access to a Roth 401k, this is a vehicle to funnel more dollars into your Roth bucket than you would have otherwise been able to just through a standard Roth IRA. Before we dive into some of those other strategies, I want to spend about 60 seconds talking about eligibility to be able to contribute to a 401k plan. In general, employees need to be 21 years of age and have completed 1 year of service. Now, these requirements apply to employees of Lockheed Martin and are fairly standard at other companies as well. Many employers utilize a plan feature known as automatic enrollment, which, as the name implies, automatically enrolls new employees in the 401k plan once they meet the eligibility requirements. Using Lockheed Martin as an example, once eligible, employees are automatically enrolled in the plan with a 4% contribution from their paycheck. And on top of that, contributions will increase by 1% each year up to 12%. And that's called an automatic escalation feature. Now, you can always opt out of auto enrollment and auto escalation, but most plans these days default to automatically begin contributing to a 401k plan when an employee becomes eligible. Now let's talk about contributions. If you've heard of the 3-bucket strategy, this is what's being referred to. You have the pre-tax or before tax bucket, which is your standard 401k. You get a tax deduction up front. You get the tax deferred growth, but Uncle Sam is coming back for his taxes down the road, either when you take withdrawals from the 401k or when you're forced to take minimum distributions in your 70s. Then there's the Roth 401k, which is becoming much more widespread as far as an offering. You'll pay the taxes when you contribute to the plan up front, but you're going to get tax-free growth forever in that Roth account. And there are no RMDs because the account's already been taxed. Now, there's also a third lesser known way of saving into a 401k plan, and that's with after-tax contributions. Similar to the Roth contributions, you pay the taxes when the contribution is made, but in a few minutes, we'll cover a tax optimization strategy that's available through some 401k plans. Moving on to contribution limits. If you've ever heard the term elective deferral, it's just a fancy way of describing the contributions made through payroll deductions to your 401k. The elective deferral limit into a qualified retirement plan for this year, 2025, is $23,500. Now, this applies to both pre-tax and Roth contributions. So if you're contributing a mix of both, the combined total cannot exceed that $23,500 limit. And that's a limit set by the IRS. That's not Lockheed Martin specific. But as an employee of Lockheed, you can contribute up to 40% of your weekly base pay to hit that limit for the year. Now, if you're over the age of 50, you're also eligible for a catch-up contribution. That allows you to put another $7,500 into the 401k. And something new starting this year, if you turn any age between 60 and 63 during the 2025 calendar year, you're actually eligible for an increase to $11,250. That's an extra $3,750. In the industry, we've started to refer to that as the super catch-up. Now, employer matching contributions, again, one of the main reasons people contribute to their 401k, it's a way for companies to incentivize employees to contribute to their retirement accounts. Companies can match 25, 50, even 100% of employee contributions, and sometimes even more. But using Lockheed Martin as an example, the company matches 50% on the first 8% that you contribute, up to a maximum of 4%. So this is how that would play out. If you contribute 4% of your salary to the 401k, the company's going to match 2% of that. On the other end of the spectrum, let's say you contribute 10%. Well, the 401k plan, as it's set up, the employer is only going to match 4% being the maximum. You're not going to get 5% being 50% on that 10%. One thing to note, these matching contributions almost always fall into the pre-tax bucket. So even if you're a Roth fan and you're putting as much dollars as you can into the Roth bucket, when your employer matches, it's going to come over as pre-tax. And I did say almost always. I can think of a few clients that we've met with that actually have a 401k Roth match, and the employer is matching in Roth dollars as well, which is an amazing benefit, not something that Lockheed's currently doing. Then we have the profit sharing plans, which allow employers to make discretionary contributions to employees' retirement accounts in addition to or instead of a traditional employer match. If you're an employee of Lockheed Martin, it's likely you're reaping the benefits of both the employer matching contributions plus profit sharing contributions, which are more broadly referred to as company contributions. As an example, let's say the company offers a profit sharing contribution of 6% of your base pay, regardless of an employee's contribution amount. How does that play out? Well, in this example, if you as an employee contribute nothing to the 401k plan, you still get the company profit sharing contribution of 6%. Now, on the other end, let's say you wanted to max out the total benefit in this situation. You can contribute 8% to the 401k. You receive the profit sharing contribution of 6% plus 50% match on your 8% you contributed. So that's a total of 10% being contributed to your 401k plan by the employee. Now, before I show you what that means in dollars, I do want to touch briefly on vesting schedules. And this refers to a timeline that determines when an employee gains full ownership of the funds in their 401k. And I know that sounds scary, but the good news is employee contributions are always 100% vested, meaning you as an employee own the money that you're contributing immediately, even if you leave the company. Employer contributions, however, typically vest over time. And that's just a way to incentivize long-term employment. The example here shows two of the most common types of vesting schedules. Cliff vesting in the middle column there, that occurs all at once on a specified date, such as after 3 years of service. In this case, if you leave the company in year 2, the company keeps anything they contributed over that time period, and you walk away with the contributions that you made over that 2-year time period. Now, we also have a graded or gradual vesting schedule, and that occurs incrementally over time. So as you can see in the table, after 2 years of service, you're 20% vested in what the employer has contributed to the plan. So if over that 2-year period, the employers put $10,000 into the plan and you leave, you're walking away with 20% of that, or $2,000 plus whatever you put in. Now, after 3 years, you'll see that bumps to 40%, and that goes onward and upward until year 6 when you're fully vested. So in this instance, if you left after year 6, everything in the plan you get to take with you. And we'll talk about rollovers here in a few slides. If you don't work at Lockheed Martin, you may want to plug your ears for this next piece of information, because this is not common. But as a Lockheed Martin employee, you are immediately vested in both your contributions as well as contributions made by the company. And again, that's a phenomenal benefit. It's just not that common out there, which would be another way of vesting called immediate vesting. So now we've covered you can unplug your ears if you're not a Lockheed employee at this point. We've covered pre-tax and Roth contributions. We're going to discuss the third bucket, and that's after-tax contributions. Now, these contributions are not subject to the annual elective deferral limit of $23,500 that we mentioned earlier. The Internal Revenue Code defines something known as the 415 limit to restrict the maximum amount that can go into a qualified plan in a given year. This means if you make $1 million, you can't put $900,000 into your 401k plan. This limit applies to all employee contributions, whether that's pre-tax, Roth, or after-tax, plus employer contributions, which includes matching or profit sharing. And that total for the 2025 calendar year is $70,000, not including any catch-up contributions. So this example on the next slide should help add some color, quite literally, to the picture. Let's say someone is a high income earner and their salary is $250,000 a year, and they want to maximize their retirement plan by putting all the puzzle pieces together that we've covered so far tonight. First, they're going to max out their 401k with $23,500 in either pre-tax or Roth contributions. This will allow them to capture a 4% match from the employer of $10,000. On top of that, an additional 6% of profit sharing worth $15,000. Now, all that adds up to $48,500. But the 415 limit is $70,000. So in this example, this prolific saver continues contributing to their 401k with after-tax dollars. Now, I'll come back to the mega backdoor Roth strategy in a second, but keep in mind, the 415 limit does not include catch-up contributions. So on top of that 70K, depending on someone's age, this person could contribute up to an additional $11,250 to their 401k with that super catch-up contribution. And that's a total of $81,250. So if you're out there trying to maximize savings in your 401k, this is your roadmap. Imagine maxing out that 415 limit over a decade with compounding growth. That adds up and can have a tremendous impact on someone's retirement. Some plans have a special feature known as an in-plan Roth conversion. This allows a plan participant to convert pre-tax to Roth within the plan, which means paying the taxes today. If your 401k allows for in-plan conversions, any vested part of your 401k account can be converted into a designated Roth account within the plan. It means it doesn't have to leave the 401k plan. It doesn't have to go to an outside advisor. This can happen regardless of your age. You don't need to be 59 and a half, and regardless of income. If you make $1 million a year, you can still do an in-plan conversion. Now, keep in mind that any pre-tax dollars from employer contributions and any growth on your after-tax contributions will continue to compound in your 401k as pre-tax funds. These are taxed as ordinary income down the road when you withdraw these funds from the account. By converting, though, you actually pay those income taxes today, and they're moved into your Roth bucket where they compound tax-free for the rest of your life. So this in-plan conversion is the final step in the mega backdoor Roth process I alluded to earlier. The mega backdoor Roth strategy is simply maximizing that after-tax bucket, then converting to Roth to stockpile more money in the Roth account beyond the $23,500 limit. Now, for high income earners looking to put as much into their tax-free bucket as possible, this is your strategy. Now, as much as I've been complimentary towards Lockheed's benefits tonight, They do only allow one in-plan Roth conversion per calendar year. There are plans out there designed for employees to be able to maximize the mega backdoor Roth strategy and actually automatically convert pre-tax funds each paycheck to eliminate that pre-tax compounding throughout the year when you convert all at the end of the year. So it just happens automatically in the plan. Now, the last thing I'll touch on tonight are distribution options from a 401k plan. Once you've reached age 59 and a half, whether that's before or after retirement, you can begin taking withdrawals from your 401k. Now, you're going to pay taxes on any pre-tax funds being withdrawn. And as we've discussed, anything coming out of the Roth or after-tax buckets won't be taxed a second time. For a lot of people, it's a little bit of an administrative headache to log in each time you want to take a withdrawal, decide which tax buckets the funds are coming from, especially when you reach RMD age. So there's option number 2, and that would be rolling the funds over to a 401 from a 401k to a traditional or a Roth IRA. This gives you a wider array of investment options as opposed to the typically limited options within a 401k of mutual funds, which we'll touch on next week. These accounts can also be managed by an outside advisor, and also those distribution strategies can be compiled by an outside advisor. There are 0 tax implications for doing a direct rollover if done properly, and I emphasize properly, meaning the funds are rolled over to correct types of accounts. An in-service distribution or an in-service rollover is the same process as number 2, but this is done while you're still working for the company whose plan you're enrolled in. Some plans allow in-service distributions prior to 59 and a half. Some only allow employee contributions to be rolled out. Some plans don't allow in-service distributions at all. All that to say, you'll need to look at the rules for your specific plan to know if an in-plan distribution is even an option on the table. Lastly, we have required minimum distributions, or RMDs. The IRS mandates that when you reach a certain age, it's time to pony up taxes on certain tax-advantaged accounts like 401ks and IRAs. If you're not currently taking RMDs, they start when you turn 75, unless you were born before 1960, in which case they'll start at age 73. Some people think that they can avoid RMDs by leaving pre-tax dollars in an employer-sponsored plan like a 401k as opposed to rolling out into an IRA. RMDs still apply to funds in a 401k. So just be prepared to take an annual distribution from your 401k when you reach RMD age, whether you need the money or not. So thank you everyone for your time so far. I'm going to let Andrew talk about pension plans now.
Thank you, Tim. So today I'm going to be talking about pension plans. Now, pensions are a type of defined benefit plan, as opposed to a defined contribution plan like Tim was talking about before with the 401k, where you as the employee are the one contributing to that plan to build up your retirement benefit. Now, a pension's a defined benefit plan, like I mentioned, so it's a little bit different. In a defined benefit plan, typically your employer promises you a specific benefit upon your retirement based on factors like your salary, your years of service, and when you decide to begin your pension. Typically, we see 60 to 65. Now, there's a few different things that you're going to want to consider when you're deciding which benefit option might be best for you. So a couple of those items are life expectancy. So what does your family health history look like? Do you have any pre-existing health conditions that you need to consider? And does your beneficiary or your spouse need to rely on that income from your pension throughout retirement? Or are there other income sources like, let's say, investment accounts or retirement savings that could be used to supplement that income instead? Now, the pension at Lockheed Martin is frozen, which means that factors like your average pensionable earnings or your Social Security covered compensation or even your years of service have likely been frozen, and those factors are no longer adding into your benefit calculation. So for most pension plans, there's about 5 to 7 different ways or options that you can decide to take that benefit. Now, the first and most common way that we see is going to be your life-only option, also known as single life. Now, this is going to pay you a level monthly income for the rest of your life. Now, if anything happens to you, there's no continuing benefit to your spouse. So your monthly benefit's going to be based on which age you decide to take your pension And there's a couple pros and cons to this option. So some of the positives are, this is going to be your highest monthly payout of any of your pension options. And if you outlive your spouse, it could be your highest cumulative benefit. However, if you predecease your spouse on the other side of that coin by several years, or if they were otherwise needing to be dependent on that income throughout retirement, or there's no other assets to live on, or maybe if you have a pre-existing health condition, then you probably want to look into some of the survivorship options instead. Now, of course, we recommend that you consult with a financial planner or a retirement specialist before making this type of decision to see which option might be best for your specific situation. Now, the next option that we see is going to be your life with a 5-year guarantee. So this is going to be your second highest monthly payout of any of your other options. And it's going to be slightly reduced from that single life payout that you would have otherwise gotten. Now, the way that this option works is if you die within your first 5 years of payments, then those payments are going to continue to your spouse through the first 5 years. Now, after that 5 years, they don't receive anything. So there's a couple reasons why you may or may not choose this option. Now, if you die within the first 5 years, your spouse is going to receive the remaining benefit for throughout the rest of those 5 years. So it's a good way to ensure that if the first 5 years of income are needed to ease the burden on your portfolio from drawing down assets in retirement, then it's good to consider this option. Now, on the other side of that, if you die shortly after taking that benefit, then you're going to, or your spouse is going to miss out on every year of income after year 5. So again, not a good option for somebody considering taking a pension with a pre-existing health condition. Now, similar to the 5-year option, we also see a life with 10-year guarantee option. It's the same concept as your life with a 5-year guarantee, except the monthly payments reduced a little bit further. So you've got a reduced monthly payout for the rest of your life. Now, if you die within the first 10 years of those payments, then those payments are going to continue to your spouse throughout the first 10 years. So similar factors to consider with this option. Now, another thing to consider is the level income reduced at a certain age option. This option is a little bit unique. It will give you a level monthly payout for a set amount of years, and then it will reduce at a certain age. So you're probably wondering, what does that look like? Well, let me show you a couple examples here. If you were to take the level reduced at age 62 option, the way that would work is you'd receive a higher benefit from ages 60 to 62. So your monthly benefit could look like $7,100 per month. And then after age 62, or once you hit that age 62 mark, it will reduce to $4,400 per month. Now, these are arbitrary numbers, but this benefit can be good if your need is a little bit higher in the early years of retirement. Let's say you've got some heightened expenses in the early years, or maybe you've got some kids in college, or some other existential factor where you need a little bit more income in those first few years. Now, there's also a level reduced at age 65 option. Now, this could look like receiving $6,900 per month from ages 60 to 65. And then after age 65, that benefit would be reduced to something around $3,400 per month. Now, again, these are arbitrary numbers, but this benefit and something unique about it is that it's typically coupled with Social Security. So what most people will do when they take this level reduced option, the reduction in your monthly benefit is based off of a Social Security index. So typically what people will do is, let's say you're taking the level reduced at 65 option. Well, you would want to line that up with when you plan on taking your Social Security benefit. So if you plan on taking your Social Security at age 65, this option is meant for you to have a level income throughout your entire retirement. So the payments would be higher to you in the early years, then your pension benefit would reduce at age 65 when you start taking Social Security to keep your income level. Now, the next option is going to be the first of our survivorship options for our Lockheed employees. Now, survivorship options are something that you're going to want to consider if you need that stream of income to continue on to your spouse if anything were to ever happen to you. So it's a good way to ensure that income's going to continue out for the life of not just the plan participant, but also their spouse. So in this option, you receive a level monthly benefit it will be significantly reduced from what you would have received with your single life option. But if anything happens to you, or if you predecease your spouse, then 75% of that benefit would continue on to your survivor. So if you were receiving $1,000 per month as your monthly benefit and something were to happen to you, then your spouse would continue to receive $750 per month throughout the rest of their life. Now, you're probably wondering, what happens if I predecease my spouse? Why would I take a reduced option or a reduced benefit if with the risk of me predeceasing my spouse? Well, the answer to that is if you predecease your spouse, if your spouse predeceases you, you receive a stepped up benefit. So instead of receiving your reduced benefit, you would be stepped up to the monthly benefit you would have otherwise received if you had chosen the 5-year guarantee option. And you receive that monthly payment for the rest of your life. So it's a way to ensure a premature death on either side. Now, we also see a more conservative option, your most conservative survivorship option, being the 100% joint and survivor option with the 5-year guarantee, or with the 5-year pop-up. So the way that this works, same concept as the 75% with the 5-year pop-up. You receive, this is the lowest reduced monthly benefit of any of the pension options. So you receive a level monthly benefit. If you predecease your spouse continues to receive the same monthly benefit throughout the rest of their life. Now, if your spouse predeceases you, then your benefit is popped up to what that 5-year guarantee monthly benefit would have been. So this is a way to ensure that there's a steady stream of income throughout the rest of your retirement and to ensure against a premature death on either side. Now, some pensions are going to allow you to take what's called a lump sum payout. Now, the way that this works is they allow you to receive your entire pension benefit as one large payment. Now, there's a couple things to consider with this. It places the responsibility of managing those funds on you as the investor. However, on the flip side of that, there's a greater potential for growth if you invest those funds wisely. Now, you're probably thinking, Andrew, if I take my lump sum all in one year, wouldn't I have a big tax bill? Well, the answer is yes. If you distribute those funds out to yourself all at once, you would normally have a large tax bill in that year. However, most lump sum pension options allow you to roll that benefit directly out into an outside retirement account like an IRA or a Roth IRA that will allow you to invest those funds and pay them out to yourself throughout retirement as needed. Now, a couple things to consider with taking the lump sum that most people don't consider is going to be, first of all, timing. Timing can impact the value of your pension lump sum. Now, yes, it can be good to get the clock started, to get the payment, to take the payment, and to invest those funds, to begin growing those assets. However, something that you'll want to consider that most people don't think about is interest rates. Interest rates can affect the value of your lump sum. And in a falling interest rate environment, it may be wise to wait. So if you think that the interest rate's going to fall in the next few years, it may be wise to hold on to that benefit. Now, the reason for this is there's an inverse relationship between interest rates and the value of your lump sum pension, meaning that the higher the interest rate is, that will lead to a lower lump sum payout and vice versa. Now, this payout's calculated by determining what they call the present value of your future pension payments. So these are considering factors like your age, your life expectancy, and of course, the prevailing interest rates. So the higher the interest rate or the discount rate that they use in your calculation, the lower the present value of those future payments. Now, let me dive a little deeper into that. This is because they're assuming that you're going to take the proceeds from your pension and you're going to be able to reinvest them at a higher rate. So the more that you can make on those funds outside of your pension, the way that they see it, the less they need to give you to survive through retirement. So the younger you are to that same end, the more that the interest rate is going to impact the value of your lump sum because they're assuming those funds are invested for a longer period of time. Now, I keep bringing up interest rates. What interest rates am I referring to? Am I talking about the federal interest rate, or what interest rate might I be talking about here? Well, I'm referring to something that they call the IRS 417E rates. Now, these are they're not as complicated as they sound. These are segmented rates based on high quality corporate bond yields that are averaged over 24-month periods. So the IRS provides these segmented rates specifically for the present value computation that's typically used to calculate these lump sums. Now, the IRS 417E rates are divided into 3 segments, which you can see up here on the screen as well. Those are each segment is going to represent a different period of time based on your life expectancy and then used to calculate that lump sum. So the first category that you'll see is their short-term category. Those are taking into consideration any high yield corporate bonds there with a duration of 1 to 5 years. That second category is any bonds with a duration of 6 to 20 years. And then that third column, that long-term duration, is considering any high yield corporate bonds over 21 years of duration. So these are the rates that they use to calculate the lump sums, and they're rolling, and the IRS comes out with these every month. Now, these benefits, regardless of which pension option you decide to take, are going to be based on a few different factors. Going to be based on years of service. So how long have you been with the company? It's also going to be based on your retirement date. So when you separate from service, and sometimes when you begin to initiate that benefit. It's also going to be based on your average pay, how much Social Security covered compensation that you have, and a variety of other factors. So it's important to make sure that you review the factors that go into your pension so that you know how to calculate your benefit. So let's review a couple determining factors. When you're deciding which pension payout option is best for you, don't just take the highest payout, the highest monthly payout. There's a lot more to consider. First, you'll want to take into consideration your financial situation. So in addition to the pension income, you're going to need something to supplement your lifestyle. Your pension income is going to be less than you receive from your regular income right now. So if you're spending most of what you make and you want to maintain your current lifestyle in retirement, there's going to need to be some other source of income or assets to fund that gap. So you're going to want to consider your Social Security benefit, any other retirement income that you may have, any investment accounts or retirement savings that you can use to supplement income. You'll also want to take into consideration things like life expectancy. Like I mentioned before, if there's any chronic medical conditions, what does family health history look like? And to the best of your ability, what do you feel like in regard to your spouse who may live longer? And then lastly, the last item that you'll want to consider is, of course, your income needs. So if you're almost solely relying on your pension income and your Social Security income in retirement, and there's not a whole lot of other assets to fund your retirement goals, then you may want to look into some of the survivorship options if you have a spouse or a beneficiary who may need that income if something were to happen to you. Now, I want to reiterate, of course, we recommend that you consult with an expert or a financial planner when trying to maximize your pension for your situation, because there's a whole lot of factors that go into it. Now, that concludes our section about 401ks and pension benefits. So now we'll transition into our Q&A session, but we've had questions popping in here throughout the presentation. So we're going to get to all that we can today. And if you have any additional questions, or if we don't get to your specific question, then you can always reach out and we'd be happy to give more information.
All right. Well, I'm getting some questions in from Mission Control here. So we'll just start at the top. From anonymous attendee, can I contribute to a Roth 401k if I'm already maxing out my Roth IRA contributions? Thank you for the question, anonymous attendee. The answer is that these are completely separate buckets in the eyes of the IRS. If you're maxing out your Roth IRA, do that all day long. Every year, max it out, assuming you're within the correct income limits. But on the Roth 401k side, that's available to anyone. There's no income restrictions to that, age restrictions. You can fill up that bucket irregardless of whether you've contributed to your Roth IRA or even a pre-tax 401k.
I see another one here that says, what guarantees that I will actually receive my benefits for the rest of my life. I'm assuming you're referring to the pension payouts on that one. Now, what ensures that you receive that benefit? Well, one, it's the promise from the company. So Lockheed Martin's made a commitment to pay you out that benefit defined by your defined benefit plan for the rest of your life or whatever the terms of your pension option may be. However, what if the company were to default? Well, Lockheed Martin specifically, their pension is covered by what's called PBGC insurance. And this is essentially a company that guarantees these pension payouts for a lot of the private sector pensions that we see, Lockheed Martin included. So if for some reason the company were to default, if Lockheed Martin for some reason didn't have enough money to pay you out your pension benefits as promised, then PBGC insurance would step in and they would pay up to a portion of your full benefit. So it's based on a Social Security index is kind of how they decide how much of the benefit they're able to guarantee. But in the event of a default of Lockheed, your pension does have a second layer of protection through the PBGC insurance.
All right. I've got another question here from Delilah, Salt Lake City, Utah. I love that. What is a reason I wouldn't convert all of my pre-tax dollars? Well, I guess it depends on the situation, but I'll give you an example of when you would not want to do a conversion in plan of your pre-tax dollars. Let's say you're 70 years old, you're retiring next year, you're a high income earner. If you convert the pre-tax dollars in your 401k this year, you are going to pay ordinary income on that amount at your highest tax bracket. Whatever that income tax, marginal tax bracket is for you, that's what you're paying. Now, if you were to wait until next year when you are retired and income essentially drops to zero, depending on other sources of income, your tax bracket's going to be much lower. That would be the optimal time to convert. So every situation is different. I wish I could say a blanket answer of convert as much as you can, as fast as you can, but that doesn't make sense for everyone. So hopefully that answers your question.
Okay, I see another question here. How do I find my pension? How do I find out what my pension benefit will be? And how do I begin my pension? Well, that's a great question. So as far as finding out what the pension benefit's going to be, you can go onto your Lockheed Martin Employee Service Center online, and you can request a pension benefit estimate. This will show you exactly what all of your payouts and all of your options are projected to be based on all of the factors that I mentioned before. And then, of course, to apply for your pension, you will have to fill out an application. Now, we recommend doing this about it depends on the company, but anywhere from 15 to 90 days before you plan on beginning your pension benefit estimate. I would always caution to fill out the application 90 days before you expect to need your pension benefit. And I would go on to the Employee Service Center to get that benefit estimate.
All right, another one here. Can you help me understand the mega backdoor Roth opportunity better? So I'm going to try to simplify it, and actually maybe it helps to jump back a few slides here. I'm going to jump back to this one. The red area on this graphic here is the mega backdoor Roth opportunity. So once you've made all your possible contributions to a 401k plan and your employer has made all possible contributions, whether that's a match or a profit share, all those dollars are going to add together and hopefully, well, potentially be less than the limit of $70,000. Now, again, that limit is for this year, and that's inflation adjusted. Next year, it could be 72K. I don't know. But the difference between what you're able to stockpile into your own 401k with the help of your employer, that $48,500, the difference between that and that $70,000 limit, you're using after-tax contributions. So you're doing an extra, in this example, $21,500 a year coming from payroll deductions, just like any other 401k contributions. You're paying the taxes, it's coming out of your paycheck, but you then have the opportunity to convert those dollars. So that $21,500, let's say you did that over a 12-month period. Well, in December, you can convert all of those dollars into your Roth bucket. So hopefully that clears things up.
Okay, I see another question here that says, how do I know if I should be saving pre-tax or Roth into my 401k? Well, for that question, it's going to depend on a lot of different factors, but specifically your situation in particular. Now, the basic rule of thumb is if you are going to save pre-tax funds into your 401k, typically that's best if you are making the highest income you've ever made in your life, you're in the highest tax bracket that you're ever going to be in. So we're assuming tax brackets are not going to go up. So typically, if you're closer to retirement on the tail end of your career, making more than you've ever made before, and you're in the highest tax bracket you're ever going to be in, then maybe it makes sense to do some pre-tax to defer those taxes. However, typically it makes most sense to go ahead and do Roth. Let's say, I'll use an example. Let's say you're a younger employee in the front end of your career. You expect taxes to go up in the future, and you know that you're making less now than you're ever going to make in the future. Well, if you're paying less taxes now than you're ever going to pay, and some of the lowest tax rates that you've ever seen in your lifetime, then you may as well go ahead and pay the taxes now to avoid paying higher taxes later and do the Roth portion. Now, I will preface by saying that it is not as simple as just those factors. There's a lot of other things to consider when making that decision, and we recommend that you consult with a financial planner to find out what's best for you.
That was a great answer. You should have done my part. That's it for this evening. We went through the questions. Thank you to everyone who attended. Sorry, I'm going to jump down a few slides towards the end here. But thank you for everyone who attended. Next week, we'll be covering employee stock option plans and self-directed brokerage accounts. That's on March 29th, next Wednesday. April 2nd will be the third of 3 webinars in this series. And for anyone listening to this, by the way, we do offer complimentary financial reviews. Take a deep dive into your personal financial situation. Just see if there are some areas we could add value. Is what you have right for you? Are you paying too much? So if that's something you're interested in, feel free to reach out to Andrew or myself, or inquire through the website, gdswealth.com. Thanks again for everyone's time. We look forward to seeing everyone next week. Have a great evening.